Let's bring in John Mowrey of NFJ Investment Group and Victoria Fernandez of Crossmark Global Investments into this discussion. Good to have you both. John, this really tees you up pretty well. I know that you've been pretty excited about a lot of the big index-type stocks coming into perhaps this part of the year. Now you feel like there's a little bit of a different risk-reward equation elsewhere in the market?
I do. Thanks for having me on this afternoon. So a couple things I would say. We had 3 down quarters in a row last year. The first quarter was negative, the second quarter was negative, and the third quarter was negative. And now we've had 3 up quarters in a row. And unfortunately, the way that the geometric compounding works, we're not back to flat. But all to say, we have had a significant rally, particularly in the tech names. And I totally agree with Adam's comment that the profit margins being more resilient allow those to be able to recoup those losses faster, plus the fact the NASDAQ trailed the S&P by 1,000 basis points, peak to trough last year. So all that set up very well for a massive tech rally. And then you got the AI cherry on top with NVIDIA's earnings and the multiple compression there. When I look at technology stocks, though, particularly semiconductors, those are now trading at the highest multiple in a decade. And if you look at that relative to defensives, for example, those had one of their worst years on record. So the utility space was trailing the market significantly. It had its worst year in 35 years relative to the NASDAQ that had its best year of start of the year on record. But I would argue that even though defensives are getting cheaper, investors should be looking at small and mid caps. The small and mid cap space has not participated in this rally whatsoever. And again, to echo a comment that Adam made, which I thought was very astute on that CPI, those small and mid caps were not able to pass through some of those inflationary pressures to the same degree. That being said, now you have the dislocation in valuations, and you have a situation where you could see earnings start to recover in the small and mid space. So I would argue that investors should look to those areas as well as utilities and banks. I think these areas have been massively dislocated. You have not seen the charge-off spike in the banks like many might have expected, and net interest margins are still holding steady. And if you look at REITs, for example, that's another area that I think is overly discounted. And you may be wondering, well, what if the Fed raises 25 bips more? My comment, if they're going to raise 25 bips more and that causes you to not be able to roll your debt and refinance at an appropriate level, you've got way bigger problems.
Yeah. Well, certainly that would be the case. You'd have bigger problems. I guess the big question is how much they've already been discounted. Victoria, how are you surveying things right now? I suppose the market as a whole has been able to say, okay, yield's higher. Maybe the Fed has more to do. That's okay if the economy holds together. And you also have those dynamics of, well, strong first half of the year makes the trend pretty friendly for the second half. So I know you've been defensive. Are you rethinking it?
Well, I wouldn't say we're rethinking it, Mike, but I think we are looking at some of the signs and saying, is it really different this time? Historically, when you've had some of the red flags that we've had so far this year, the leading economic indicators down, 13 months in a row, your inverted yield curve. We have a consumer that may start to weaken as you have the student loan issues come up. We're seeing cracks in the labor market. These are things that typically tell us that the market should be pulling back a little bit, and we're just not seeing it. And so you do have to take a step back. Our investment committee last week, we said, are we just being too stubborn in our view? And as we look at all of the factors, we go, yes, there is some strength in the economy, but there's still a lot of stuff waiting on the sidelines that we think is going to work its way through. So we're not saying come out of the market. We're not saying be 100% bearish, but we're saying you need to be cautious. You need to have some exposure to some of these names that the guys are talking about, some of the tech names, some of the more cyclical names. Have those in your portfolio. But I also think you need to have some exposure to some more staple names or some more value names in case you see the market pull back a little bit. Healthcare, you've been talking about healthcare. I think that's a great place to have it. McKesson is a name that we've added recently, even Elevance Health. But I also think you can find some tech that's maybe not as expensive as those big 7 that you've had out there. For us, you can look at something like an Adobe or an Oracle, where the PEs are much lower. Obviously, one of the things we're looking at is this is the 3rd quarter in a row that the majority of the gains in the S&P have been from PE expansion. And at some point, we think you're going to have to pay the piper, and that's going to come back. We're worried about that.